Taking a look at Goldman Sachs investment banking business is usually a great way to get a sense of what's going on in the global economy. People continue to ask us why there isn't more M&A activity in an environment where you have low growth, very, very low interest rates, and lots of access to capital. Confidence really has a lot to do with that. And at the end of the day, when we talk to CEOs, and CEOs are looking to grow their business or to potentially make acquisitions that are in some way transformative, they have to step back and take a look at what's going on in the world. One of the things they're doing is they take a look at the situation in Europe and they say to themselves, is this something that could really go off the rails? Is there a chance that the currency or the situation in Europe could really unwind? In that scenario, there'd be a significant shock to the global economy. And when you underwrite a significant transformative M&A transaction, you don't want to believe that there's any possibility, except for maybe a small tail risk that could happen. And certainly, that lack of confidence in the macro environment in Europe has affected CEOs' ability to take action. Our clients are very, very focused on how they fund their businesses. When you think about funding, it's always been something that historically has been the responsibility of the treasurer or the CFO, but in an environment where funding has been more challenging for some businesses, funding's becoming much more strategic for many companies. 70% of all corporate funding in the United States comes from capital markets activity as opposed to from banking institutions. In Europe, that's very significantly reversed. Today, if you look at Germany, for example, only 10% of the corporate funding in Germany comes from the capital markets, and 90% comes from banks. While the European banking system has certainly added more capital, their balance sheets are certainly, from a regulatory perspective, going to be under pressure to shrink. And as those balance sheets shrink, a significant amount of the funding that they've provided to corporations is going to have to be pushed into the global capital markets. And so there's a real dialogue that's developed with corporations in Europe about their ability to transfer some of their funding from banking institutions into the capital markets. And we see that as a long-term or a medium-term trend, and it's something we're very focused on with our clients. Right now, our clients are incredibly focused on the availability of debt capital and the cost of debt capital on a global basis. The absolute coupon levels of the cost to borrow has really never been lower over the course of the last 50 years. In that context, we're seeing lots of clients appropriately continue to lengthen the duration of their debt maturities in order to take advantage of this very, very attractive long-term financing environment. Now, despite the attractiveness of long-term rates and the availability of all these debt flows, we have not seen a lot of equity issuance. And equity issuance has been relatively subdued over the course of the last 12 months. Part of that comes back to people's lack of confidence in growth around the world and the volatility we're seeing. Generally speaking, equity issuance runs at about 2% of global market cap, and over the course of the last year, equity issuance has been running at about 1% of global market cap, or about half of the usual level. We would hope that this would pick up sometime in the course of the next 6 to 12 months, but with the economy relatively sluggish on a global basis, with a little bit more of a slowdown in China, with the continued concerns in Europe, we might see a period of time here where equity issuance remains relatively sluggish. The world has been incredibly volatile over the course of the last 4 or 5 years, and there's no question the impact of the financial crisis has had an overhang or has been a headwind to global growth. Most of our clients remain focused on trying to grow their businesses and expand their portfolios and position themselves in the world in places and markets where they expect they will find growth in the coming years. Volatility has come down a little bit over the course of the last 12 months, and we're optimistic that the capital markets will remain open and provide opportunities for our clients to fund and build out their portfolios of business.